There are few things as polarizing as a stock market at a crossroads. Some say we're poised for a golden era of investing, while others warn of an imminent crash. Who's right? And more importantly, what does it mean for your money? The stock market isn't just a place where shares change hands. It's a living, breathing entity that reflects the thoughts and sentiments of millions of investors from around the globe. It's shaped by technological innovations, shifts in political power, and our collective beliefs, hopes, and fears about the future. And right now, our beliefs are at odds. On one side, we have the bulls, who are banking on a prolonged boom powered by AI and political stability. On the other side, the bears are sounding the alarm bells, warning of a potential economic downturn that could send the market stumbling. As we explore this debate, remember that the stock market is more than just a barometer for economic health. It's a reflection of human emotion, global events, and future possibilities. And while no crystal ball can predict the future, understanding the arguments on both sides can help you navigate the market with a more informed perspective. So, let's explore the arguments from both camps and uncover the key factors that could determine the direction of the markets in the coming months, as well as your next investment decisions. First, let's take a look at the arguments put forth by the bears, who are raising alarm bells about the state of the market. Bill Gross, known as the legendary Bond King, is waving a red flag, warning of a severely overvalued market. He also reminds everyone that the consequences of the Fed's decision to raise interest rates rapidly and significantly have yet to fully materialize. In a recent Bloomberg interview, Gross highlighted the elevated PE ratios and the alarmingly low equity risk premium as factors that concern him. Specifically, he noted that the expected returns from stocks are now almost on par with risk-free investments like 10-year treasury bonds. This is worrisome, given that the equity risk premium has historically been significantly higher than it is now. So, what exactly is the equity risk premium? Simply put, it's the additional return investors can expect to earn from the stock market compared to a risk-free rate. Currently, the equity risk premium is much lower than its historical average and is dangerously close to the risk-free rate. The equity risk premium typically tends to rise during times of economic instability or market volatility and falls during periods of economic stability and growth. However, if the anticipated return from investing in stocks is the same as investing in a risk-free asset, why would you choose to put your money at risk? Suppose more investors sell their shares and put their money into treasuries. In that case, the equity risk premium should return to a level that adequately compensates stock investors for the additional risk they're taking. Gross also highlighted that the US and China are witnessing economic slowdowns. In China, economic growth has slowed to just 0.8% over the past 3 months. Meanwhile, the US leading economic index has fallen for 15 consecutive months, suggesting a contraction is imminent. But there's more to the story. Gross also pointed out the inverted yield curve, a phenomenon that has been a reliable predictor of recessions. This happens when the yields on short-term bonds exceed those on long-term bonds, reflecting investors' fears of an impending economic downturn. In Gross's own words, a thriving, finance-based economy can't do well if low-risk investments yield more than high-risk investments. On the other side of the spectrum, the bulls are optimistic and are pointing to the anticipated rise of artificial intelligence that is expected to significantly boost productivity and profits. Investors are already pouring money into companies like Nvidia, Microsoft, and Alphabet that stand to benefit from the AI boom. But it's not just AI adoption that is fueling the bulls' optimism. Ken Fisher, a billionaire investor, sees a bright future for stocks. He attributes this to what he calls gridlock gravy, the period of legislative quietness that comes after midterm elections. According to Fisher, the reduction in political risk is due to a decrease in uncertainty around new, controversial laws being passed, which helps to boost stocks. Furthermore, Fisher believes this gridlock will help keep the stock market in positive territory well into 2024, as inflation slowly wanes and the economy continues to grow slowly. Nobel economist Paul Krugman is also joining the chorus of optimists. He argues against the predictions of a recession, citing a slowing inflation rate and a booming job market. Inflation dropped from 9.1 to 3.3% in July, while unemployment rate remains low at 3.5%. Krugman also highlights that while the Fed's rate hikes have discouraged spending, the economy has so far shrugged off higher interest rates. Factors like the rise of remote working and pent-up travel demand may be, in part, why we could avoid a recession. As for the inverted yield curve, Krugman argues that the inverted yield curve merely reflects the market's apprehension about an impending recession rather than a predictor of recessions. So who's right? Well, it's more complicated. In this tug-of-war, both sides present compelling arguments. The slowdown in the US and China, the inverted yield curve, and the low equity risk premium give credence to the bear case. On the other hand, the adoption of AI, gridlock gravy, and the economy's resilience to higher interest rates support the bull case. At the end of the day, the stock market is not an exact science. It's an ongoing narrative shaped by a myriad of factors. As investors, it's essential to stay informed and consider both perspectives when making investment decisions. And it's equally important to remember that the stock market is unpredictable. Be vigilant, stay informed, and think critically. Investing is as much about managing risk as it is about seeking reward. And as we navigate these uncertain times, it's crucial to strike a balance between both. Now, it's your turn to join the conversation. We'd love to hear your thoughts on this stock market debate. Are you leaning toward the bull or bear camp? What strategies are you employing in these unpredictable times? Share your insights and opinions in the comments section below. And if you found this video helpful and informative, give it a thumbs up, share it with your fellow investors, and subscribe to our channel for more in-depth analyses and expert insights on the latest trends and developments in the financial world. We're dedicated to helping you stay informed so that you can make the most of your investment journey. Until next time, happy investing!